The quick ratio is a ratio that we calculate very quickly. All kidding aside, actually there is a lot of truth to that. The reason it's called the quick ratio is because it can be done very quickly because it's very simple. The quick ratio, in fact, takes a very specific look at current assets, current liabilities, and it divides the assets by the liabilities to give us a picture of how quickly and easily a company is able to pay off its short-term debts with the assets that it has, which are liquid. And that's the quick ratio, and that's why we call it the quick ratio. So we have to exclude things from assets such as inventory, because inventory may or may not be liquid. We may or may not be able to convert inventory into cash fast enough to pay off those short-term debts. So we don't include things like inventory, but we do include cash. We do include accounts receivable because we do normally expect to collect those pretty quickly. And we take a look at those kinds of short-term current assets that we reasonably expect we could use if we needed to satisfy our short-term debt obligations. That's what the quick ratio is, and it tells us, what does it tell us? It tells us a little bit about the financial health, the liquidity of the company. Again, how easily can this company satisfy its debts if it needs to? If its assets are 2 times its liabilities on the short term, then that's a sign of a pretty healthy company. Now, why is this important? Lots of banks look at this. Investors or potential investors will look at this. In fact, very often, when you obtain financing from a bank in the form of, let's say, a line of credit, the bank will require you to maintain that quick ratio at a level of 2.0 or above. So let's take a look at this, because as a bookkeeper, this is a very easy to calculate a measure that you can provide your clients or your boss with that will really wow them in terms of the information and what it tells them about the financial health, more specifically the liquidity of their company.
Hi, this is Seth David from schoolofbookkeeping.com. Welcome to Bookkeepers Delight, Section 2, Lesson 1, What is the quick ratio and what does it tell us? What is the quick ratio and what does it tell us? That is the question before you, and I am going to answer it. I'm going to tell you exactly what it is and what it tells you. And the reason I brought this in is because I think it's easy enough to, even without understanding detailed ratio analysis, this is one thing you can easily do, easily understand, and therefore easily explain to your boss or your clients. And the fact is, we're going to be doing a full-fledged course on fundamental analysis, which is all about ratios, and we'll get much more detailed and much more complex. But for now, the quick ratio, very simple, very easy to understand, very powerful piece of information that you can use to blow away your client or your boss with what you're able to tell them about how their company is doing. So if we run a balance sheet very quickly, and very quickly put, the quick ratio is a quick analysis of the current assets divided by the current liabilities. Now, I want to be clear what's included and what's not. We'll include cash, because cash is something I have available to me to be used immediately, if and when I need it. Accounts receivable, same idea. I expect, in most cases, that I'm going to be able to collect my accounts receivable, let's say, for most companies, on average, within 30 days. I know there's exceptions, but I'm saying in general. So we do consider accounts receivable when performing this calculation. I would not include prepaid insurance, even though it's technically classified as a current asset, because this is never going to get converted into cash. In fact, it's the opposite. It's cash we've already spent. We're never going to see that money unless we cancel the insurance policy, and even then, that's assuming it's refundable. So no prepaid insurance. Employee advances, maybe, maybe not. I'm not going to count on my employees to pay me back. I'm going to be conservative about that. Definitely do not include inventory, because inventory may or may not be saleable quickly enough to use that money when I need it right away. Undeposited funds, yes, because that literally represents money I've received but just haven't put in the bank yet. So I would definitely consider that. So take the total checking savings plus the accounts receivable plus undeposited funds. And pretty much that's the current assets figure that we're going to use for purposes of the quick ratio calculation. Then moving down to the next section of the balance sheet into the liabilities, we're going to look at current liabilities. We're going to take accounts payable. We're going to take credit cards. Right? We could probably even do payroll liabilities and sales taxes payable and include all that stuff. Add these liabilities up, go back to our current assets figure, and we take assets divided by liabilities. Using a simple example to illustrate, let's say that my total current assets were $100. Let's say that I had liabilities of $25, current liabilities. The quick ratio would be the 100 divided by 25, which would be 4, right? Which means I have a quick ratio of 4.0. I could pay my liabilities off 4 times over if I needed to. Not that you would ever need to pay them 4 times, but the point is I have plenty of cash around if I need it to settle my current debts. And that's what the quick ratio really tells us, is it tells us how liquid am I? How able am I to settle my debts tomorrow if I needed to? The more able I am, the better a sign that is that my company is a healthy company financially.
Keep in mind that at the end of this section, you're going to have another addition to a really cool, really powerful, really easy to use and easy to understand tool that's going to give your boss or your client, or if this is for your own self, then it's going to give you really valuable information that's going to help you make important decisions about your company.